I see vintage in your future. Hey everybody, welcome to Zoe's Treasures. This is our monthly tax and accounting talk show, and where we just kind of talk things, all tax and accounting, best practices and tips. I did not put it in my show notes, but I do need to give a little disclaimer. Hello, how are you guys today? Oh, thank you for the opening. That's all my husband. He does the graphics. But I was about to say, I do have to give a disclaimer. I can't give specific personal tax advice. I talk a lot of generalities, what the IRS regulations say, how to interpret them, best practices for accounting. Having said that, though, I will try to answer any questions that are put in the chat. But considering every single person has a unique set of facts and circumstances that go into their kind of tax makeup, it's hard for me to give personal advice, but we can talk kind of in general if you have questions. So please, please, please feel free to put questions in at any time. Today's show is we were going to go over the expense section of Schedule C. So last month we went over the income section. And so this month we're going to do expenses. If you missed last month's show and you're interested in how do you report your income, what do you do with your 1099s, we do have all of those shows on YouTube, so you can go back and refer to those. We used to keep them on Whatnot. They're still there, but I think Whatnot took away a lot of the past shows. So you can see ours over on YouTube. And with that, we're going to head right over into our Schedule C. We're going to talk expenses. We're going to go line by line. What does each line mean? What do you put there? What can you include? And then at the end, I have a few tips and tricks, a few of those, fun little tax things you can do just to make your situation better. Now, I do want to say for those of you who are new, we focus on the Schedule C. The Schedule C is the form that you file with your 1040. This is if you are a sole proprietor or you are a single member LLC. If you're an S Corp or a multi-member LLC, you file different forms. We really don't go into those, mainly because the majority of people on Whatnot are sole proprietors. So we just really focus on the Schedule C. So having said that, let's go ahead and we're going to switch over and take a look at that schedule. And we're going to go line by line. And at any time, feel free to put questions in there. All right, so let's see if I can make this bigger. We'll come down here. All right, so part 2 is where we're going to start. Part 2, Schedule C. And this is the expenses. So you've already put in your income at this point. You've done that. Now you're trying to gather all those expenses, that all that money that went out this year. So the very first line is advertising. That's a pretty easy one, right? But let's think of it in the terms of Whatnot. What could that be? So generally we would think advertising like TV, newspaper, if anybody reads newspapers anymore, things like that. But let's think some of the other things. Promos that you do on Whatnot. If you're paying for ads on Whatnot, boosts on Whatnot. If you do sponsored giveaways, not you, but if you go into somebody else's show and you pay for a sponsored giveaway, that's advertising yourself. You're paying money, you're getting nothing in return except recognition for who you are and what you sell, right? That's advertising. So when you look at this line, make sure you're kind of thinking about all of that. The other thing that can be advertising is if you ever give money to sponsor one of your kids' teams, not paying their team fees, but do you pay to put your business name on the back of their baseball t-shirts or softball shirts? Business cards, that would be printing. I would put business cards under office expense. But it could go here. The IRS isn't super picky. Like if you have something small like business cards, they're not going to argue with you about that. You will notice that while the IRS is very regulatory and they have like written out rules, there are some gray areas. And this would be one of those gray areas. Like business cards can kind of fall into either or, and it's more of a matter of preference. But what I really want you to do is kind of think outside the box of those things that you may have paid for. By the big one that comes to my mind that's outside of Whatnot is like for sports teams and stuff if you give them $50 for something, and not buying their candy bars or buying their popcorn, but like if you're advertising, using it for advertising expense. All right, now let's go to line 9. That is car and truck expenses. So here you have some options. This is a good one where you have some options. You can either do actual expenses or you can take the standard mileage rate. So if you take actual, and I have some notes here, I went through all the IRS regulations this morning just to make sure I was on point. So if you take actual expenses and you need to pick one or the other, so you get your vehicle, you pick what vehicle you're going to use, and you pick one or the other, standard or actual. And actual would be the gas you're paying, the repairs, the plates, you depreciate that vehicle. So this is everything you actually that you put into that vehicle. Or you could take the standard. Standard is 67 cents. It's so much easier. There's a ton less record keeping with standard. You don't need to know every time you got gas, every single repair, license plates, registrations, like all of that you don't really need to keep track of for the business. If you just take standard, 67 cents a mile. That means if you drove 1,000 miles, that's worth $670. That's pretty darn good. And it's easy. The only thing you need to do with that one is keep a log. So you have to have some type of log. It could be electronic. It could be written down. It doesn't have to be fancy. It could be like a little notebook you keep and you write the date and the mileage, where you went. I have been using, and this isn't a plug for them, but I started using QuickBooks online, and there's a built-in mileage thing, and it actually runs in the background. I don't even have to do anything. I just go about my day, and then at night or every couple of days, I open it up and I'm like, I forget if it's swipe left or right, but it's like I can say personal or business. If it's personal, it just kind of files it away somewhere. If it's business, it's what the business purpose is. And you can have a few preset saved things in there. So I have like post office, auction pickup, stuff like that. Super easy. I've been loving it. It has made my mileage, how I do mileage, just so much easier. But the whole thing is keeping some type of record. IRS doesn't care what that record is, and you don't even have to submit it with your taxes. When you need it is if the IRS ever says, hey, guess what? We're going to audit you. Prove to me that you really drove, 3 million miles last year. That's when you need it. All right, so that's car and truck. Let's go keep looking down. Let's see what our next line is. The next one is line 10, commissions and fees. So this is a kind of a tricky one. Commissions and fees is anything that you've paid to somebody, or you could put your whatnot fees in there. Realtor fees, if you purchased something that you needed a realtor and you had to pay specific commissions or realtor fees for that. But the other thing that goes in here is if you hire somebody and you're paying them like commissions, like a contract worker. If you pay somebody cash, or even you write them checks, but they're not your employee, you do not do payroll tax, but you're paying them maybe to help you ship or help you list stuff or help you pack stuff, not family members. We're talking somebody not related to you, and you hire them. This is commissions. That's where you would put that expense there. Keep in mind, if you pay somebody over $600, you have to give them a 1099. So just like you got a 1099 for the money you made on whatnot, if you pay somebody else in your business to help you out, you have to give them a 1099 if you pay them over $600. Now the 1099 is a little bit different. It's either a 1099 NEC or a 1099 miscellaneous, depending on what they're doing for you. But that's just something to kind of keep in the back of your head, because on this line, if you put that you had over $600 of commissions, this is my first year, so I have not seen a breakdown of the fees. The only way I have seen the breakdown, so the question was, if you guys didn't see it, does Whatnot send you a breakdown of the fees you paid at the end of the year? I have not seen like an annual statement from Whatnot. I cannot locate that. I can locate, however, a monthly statement. So you would have to use those monthlies and add them together to get all of your fees. But so hopefully that answers your question. Going back to the commissions, just one thing to keep in mind, if you put over $600 on here and you have not issued 1099s, that is a red flag for the IRS. I'm not saying you're 100% going to get audited. I'm just saying that is one of those like red flag things that their computer system will say, hey, something doesn't match up here. So just kind of keep that in the back of your head. All right, let's keep going. The next one is contract labor. That is, I'm sorry, I was already moved on to contract labor. What I just described to you was about the $600 is contract labor. I skipped the line in my head. So, all right. And then depletion. 9 times out of 10, this is not going to count for you guys, but depletion's like using timber resources or, let me move it down. Sorry. Depletion. I'm on line 12. Depletion. This isn't really going to count for whatnot, but I'm going to tell you what it is, just in case you ever come across it, a little bit of knowledge. But depletion is like using up natural resources. Oil, mining of any sort, forestry. So you think of like anything natural, and it's slowly using that over time. Obviously, we're not really doing that on whatnot. So you'll probably just leave that line blank. Then we go to line 13 is depreciation and section 179 expense. See if I can, there we go. Okay. This one's a little bit tricky. So the general concept of depreciation is if you buy an asset, you buy something tangible, such as computer equipment, your camera equipment, very expensive cell phones. I mean, nowadays cell phones are, you can spend easily over $1,000 on a really nice Apple. Things like iPads, things like that. If you buy desk furniture, if you outfitted a whole office of furniture or home office or whatever, those are fixed assets. So those assets, if the life of that asset is expected to last a year or more, and it costs over a certain threshold, generally $500, I'll explain that in a minute, the standard practice is to depreciate that. That means I can't buy a $2,000 camera and say, I'm going to just write off $2,000 on my taxes. I'm going to expense $2,000. No, because that camera is going to last me for 3 or 4 years. So say if it lasts for 4 years, I can take 25% in year 1, 25% of that expense in year 2, 25% in year 3, so forth, until I take that expense over the life of the item. Now, there's a couple caveats to this, as tax there always is, and this is why I say make sure you get yourself a good accountant, CPA. There is what's called a Section 179 expense, and that's where the IRS allows you to go ahead and take all of that expense in the first year. This is where the big picture comes in. So let's just assume we're going to stick with I bought a $2,000 camera in year 1. I've just started whatnot. I'm doing this right. I'm going to buy this expensive camera. Maybe I didn't make a lot in my first year, and I have a lot of other expenses. So I'm already taking a big loss on my business. This gives you some leeway to play with those expenses and do some future tax planning. I can elect Section 179 and take that $2,000 in year 1. Or I can say, you know what? I've just started this business. I'm already taking a loss. I don't need any more loss. I expect to have a lot more income in year 2, 3, and 4 because I'm smart and I'm growing this business and I know I'm going to be successful. I could then defer some of that expense to year 2, 3, and 4, taking 25% each year. So that's where you start to get your tax planning, to start offsetting some of your expenses to your income. Hopefully that kind of makes sense. I would suggest a lot of this is very high level and looking at a big picture, working with a CPA or an accountant to kind of look at that big picture and see where you're going to go. How does it fit into your goals? How you should move when you have an option of whether to take expenses this year or in future years, what would be the better choice for you? I mentioned fixed assets, and I said there was kind of 2 things about a fixed asset on whether you need to depreciate it or not. The first was if it's going to last, it's called the useful life is more than a year. The other is the cost. Generally, a lot of small businesses say, okay, anything over $500 that lasts longer than a year is a fixed asset. There's no dollar amount that the IRS sets. Each business, even you as a sole proprietor, as a business, sets that dollar amount for your business. And you set it once and you can, it's in your head. It's not anything you have to write down, but you're like, you know what? I'm going to go with anything over $1,000. I know me and my business. I know if I buy a desk, I'm probably keeping it under $1,000. I can expense it in that year. But if it's over 1,000, you kind of have to have a cutoff line. You need to establish something and something reasonable. Again, the IRS isn't going to tell you what it is, but you need to just make sure it's reasonable in case you get asked, in case you're audited. I know that's kind of like there's a lot of pieces to that concept. So if you have questions, I'm happy to expand on it more, but I'm going to move on. I can always come back and talk more about it if that's something that you have questions on it. All right. So we are on line 14, employee benefit programs. So this is anything you set up for your employees, if you have employees. If you don't, skip the line. But if you do have employees, and as a sole proprietor, you could very well have employees. If you have employees and you have a benefit program for them, you're paying for their health insurance, you're paying for their gym membership, whatever it may be. If it's a benefit to that employee, just as if you're working and your employer gives you specific benefits, that's where you would put the expense of that. Then we have line 15, insurance. And it says other than health. Do you have to pay liability insurance? Do you own a building that you pay like some type of casualty or loss insurance on? Fire insurance, flood insurance for the business. Not that insurance that you have for your house, but we're talking about insurance for, maybe you just have an insurance policy on your inventory. Do you have insurance that covers the business in some sense? That's where you would put that expense. Not your health insurance. That's separate. That comes in another spot. Then we get to line 16, which is interest. And underneath there's a part A and B. So you have mortgage and other. So this is just like your personal interest. Now, you don't put your personal interest on there, but the concept's the same. If I take out a business loan, a truly business loan, I am not using it for personal expenses. And if I take out a loan from the bank, the bank's not going to loan you money without charging you interest. That interest portion that you're paying back is an expense. So you would put it there. Credit cards. Do you have a credit card that you use for your business? I'm sure you pay interest on that credit card. I don't know if there's any credit cards out there that are 0% interest. You need to put the interest there. If you are taking actual expenses on your vehicle and you are have a loan on your vehicle and you're doing the actual expenses, I'm sure you have interest there. Well, you may. Cars, sometimes you have 0%, but sorry, my husband's talking to me over here. He's like giving me instructions and I'm like, getting confused. So any interest that you would pay, that is a legit business expense. Hey, welcome in everybody if you're just joining. My name's Tracy. This is Zoe's Treasures. We are going over to Schedule C, the expense section today for our tax and accounting talk. All right. If you want to, if you've missed the first half or you want to learn about the revenue, we are on YouTube, so you can go check that out too. All right. Back from my commercial break. I always feel like a commercial when I have to stop and say things like that, but I want to make sure that I'm including anybody new just coming in the room. All right, let's go back to our form. So we talked about interest expense, line 16. So think about that. Any business loans that we have, you're going to want to put any of your interest there. Then 17, legal and professional services. That's almost self-explanatory. If you had to hire an attorney, I am so sorry that you've had to hire an attorney for a business purpose for anything. Hopefully it was for something good. But any attorney fees, those are all legal fees, so you can put them here. Professional fees means the money you pay to your bookkeeper, your CPA, or your accountant. YouTube profile. My husband will throw that across the top so you can see that. We are Zoe's Treasures. So legal is pretty self-explanatory. You had to hire an attorney for any reason. You got that. Professional fees, your CPA fees, or any other type of professional service that you may have employed. Thank you so much. All right. Let's see here. Okay, line 18. We're going to keep moving on. Office expenses. So this is a big one. This encompasses so much stuff. And you think, hey, I run whatnot. I don't have an office. But maybe you pay personal postage. Sorry, my hair's getting in my way. Personal postage, not personal postage, but like you're just, maybe you have to pay a bill for the business or something, and you're going and buying stamps for the business. That's an office expense. Maybe you're buying a filing cabinet, paper, labels, all of those things, all of the normal things that you would buy would be office expenses. So you can put them there under office expense. It's a pretty broad category, so it's, again, it's kind of up to your interpretation of office expense. As long as you're being legit in your expenses, you're not going to get in trouble for it. Then pension and profit sharing plans. So this is only for employees. Let's see. I just want to get this right for it so you can see it. There we go. Row 19, pension and profit sharing. This is for pension or profit sharing that you pay for your employees. You don't have employees? Skip the line. But if you do have employees and you offer some type of 401k plan, some type of retirement plan, this is where you would put the expense. Now, you would know. There is so much in setting up something like that, that if you did set something up like that, then you probably have some professional and legal fees too to go along with it. So you would absolutely know if you had that type of plan. And this is, again, I'm going to really stress this. This is for employees, not for your own personal plans. Then we come up to line 20, rent or lease. And we have a part A or B here. So we have vehicles, machinery and equipment, or other business property. It's pretty self-explanatory. I rent a storage unit to house a lot of my excess stuff in. That's an expense. I'm sorry, I'm holding off. For some reason, my husband put our animated frog on the screen, and I want him to get my form back so we could talk about it. He's over there frantically pushing buttons. It's so funny to watch him panic. So I'm going to keep talking while he is trying to figure out what is going on with the screen. I do apologize. So we were on rent. I rent a storage unit, just a little storage place that I keep stuff in. That's rent. If you rent a, you are like just killing it at rented a warehouse. That's an expense. Rent for your own space, for like a rent, like paying rent for a home office, that doesn't go here. We're going to talk about that in a little bit because I have some tricks on that one. But if you've rented any machinery or equipment, maybe you've rented a bubble wrap making machine or something, put it in there. So anything that you have rented, you can put in there. Vehicles, if you went on a business trip and had to rent a vehicle, you can put it in there. And then it says other business property, and that's the catch-all. That's like, hey, I rented whatever it may have been, and I can't even think of what an example of something you would rent that's not vehicle, machinery, or equipment. But if there is something, you can put it in that other business property. To line 21, which is repairs and maintenance. This is to do repairs and maintenance to any of your normal stuff. You crack your iPhone screen and you use your iPhone for whatnot, and you have to go pay, I don't know, $100 to get it fixed, right? I'm fixing it. I'm maintaining something. You got to fix your office, desks or whatever it may be that you are fixing or maintaining. You put that expense there. That is not to replace, though. Replacing is like you're buying it all over again, and then we get back into our fixed category. And I am so sorry, honey. You just had it. Cannot see it anymore, so I don't know what I'm talking about. All right, there we go. Okay, so repairs and maintenance. To that fixed, all those fixed assets we talked about at the beginning, anything you're paying to keep those up and keep those in good shape is repairs and maintenance. Then we supplies, row 22. This is anything that's not included in part 3. We're not going to go into part 3. We're not going to worry about that right now, but let's just talk about supplies. This is the general supplies you need as a reseller. Now, you can put them here or you can put them in office expense. I like to kind of segregate it out just because I'm a little bit, picky about things. But let's talk about your packing tape, your boxes, your bubble wrap, your packing paper, shipping labels, all of those supplies that you're buying to do what you do. You can put those here under supplies, or if you prefer, a lot of those will classify as offices. So it's kind of up to you. Car repairs, good question. So the car repair, you would only put repairs for your vehicle if back on our on line 9, if you were taking the actual expense. So under car and truck expenses, if you're claiming the actual expenses, then that is where you would put repairs. But if you're taking standard mileage, that standard mileage encompasses those repairs, so you could not put the repairs there. That's called double dipping, so you couldn't claim them twice. All right, so that's repair. Or we did repairs, we did supplies, taxes and licenses. We're flying through here, but we're going to get to home office pretty soon, and that's kind of a big one. Let me just kind of flip to make sure I'm got all my notes. Okay, so let's see, taxes and licenses. So if you are incorporated like as an LLC, a single member LLC with your state, most states charge you an annual fee for that. That's taxes and license. If you have to pay, if you own property and you're paying real estate taxes for the business, then you have to you pay real estate taxes on that property. If for some reason you have an auctioneer's license, you would put your license in there. If you have a professional license that is in connection with your business. So I'm a CPA. I have to renew that every 2 years. It costs me money to renew that. But that CPA license has nothing to do with whatnot. Even though I talk tax and accounting here, it really has nothing to do with it. I don't put that on my Schedule C. So any taxes or licenses that apply to your business, you would put there. And then we get to travel and meals. So, okay, this is a big thing because I hear a lot of comments of, oh, I'll go to Hawaii and I'll go to a few Goodwills while I'm in Hawaii and write that off as a business expense. Wouldn't that be wonderful? That would be so nice. The IRS is really, really picky when it comes to travel for business. So this is one of those areas that I would just strongly encourage you to really, really be as exact as possible in. Not that I think anybody should cheat, but other areas such as office expense, some of these other areas I've said, oh, there's a little bit of gray area there. Travel, they are so picky. I just wouldn't play around with it. So travel is, you are legitimately going on a business trip. You can pay for your travel expenses, if it's an airplane, if it's, you're renting a vehicle, hotel, those type of expenses, you can pay for yourself, not for your family. So if I want to take my daughter and go on a road trip and travel 5 states away, and we're going to hit thrift store after thrift store, and my main purpose of this trip is to go to thrift stores and antique stores along this path, and then turn around and come back and hit some other ones, it is a business trip. I'm going to put all of that expense as business for me, not for my daughter. Say if we are flying somewhere, here's a perfect example. Whatnot does those get-togethers, right? Where's the big one? I think the big one's in Ohio. If you fly to that Ohio, if you have to fly to Ohio and get a hotel, and it's you and your spouse that go, say your spouse has nothing to do with the business, you just want to take advantage of this and have some time with your spouse. Your airline and the hotel is totally deductible. Oh, I will answer your question in just a second. Your travel is totally deductible. The airline for your spouse is not deductible on there. Let's see. I live in Ohio. Okay, so honestly, I don't know. I just hear about it every year. I think they post it maybe in some of like on Discord or something. They probably talk about it. If anybody's in the chat that knows when that meetup is, I do know that they do it once a year. And the way I've always heard about it is just word of mouth, or I've seen it in Discord. Oh, well, you're welcome. Thank you. I appreciate you guys being here and listening to me talk about tax and accounting. I know it's not always the most exciting subject to hear about. But let me get back. I want to get back to travel because this is super important. So it's for you, for business, for specific rules. Now, going outside of the country is a big no-no. That is pretty much not allowed. There are specific circumstances. If there's a business meeting outside of the country, and I think the IRS says less than 7 days, and it's reasonable for the meeting to be held outside of the country, and you're going for the sole purpose of that business meeting, you could probably get away with that. That's legit. But let's think about this and whatnot. I mean, that kind of doesn't make sense. Like, where would we be going outside of the country? So you've got to just be reasonable about it. Perfect example of this. Over Christmas, we went to Mexico for 3 weeks. No, I wish I could. If you could figure out a way to go to Paris flea markets and make it deductible, please call me. I'll go with you. And I was going to give an example. Over Christmas, we went to Mexico for 3 weeks. We traveled from one side of Mexico to the other, took this huge road trip. I purchased like 3 suitcases full of stuff to bring back, and I sold it on Whatnot. So while I did business stuff there, it was not a business expense. I cannot claim any of that. We stayed with family while we were there. It was really to visit family. And because we were there, I was going to take advantage of the situation and buy stuff to bring back, but it wasn't really business. So that's kind of like one of those things. Those are the perfect examples. You'll hear people say, oh, well, you went and bought something in Mexico, so you get to write that whole trip off. I wish, because those plane tickets for 3 people, for me, my husband, and my daughter, were super expensive. But no, can't write that off. Now let's kind of flip this. What if you live in El Paso and you're right on the border to Mexico, and you drive over the border, 30-minute drive, pick up some Talavera, and bring it back? That's no different than me being in Pennsylvania, driving 30 minutes to Maryland, picking something up and bringing it back. That's deductible. So you can kind of see the difference between the vacation versus a normal business purpose. The other part on travel is tips. So tips, you go any place, you got to tip the bellhop. You've got to tip the you've got to tip the bellhop. You've got to tip the I'm sorry, my husband keeps talking to me and he's driving me insane because I cannot talk and listen to him at the same time. All right. So tips, sorry about that. He's over here going, and I'm like, what are you saying? Okay. Tips. Thank you for saying it's okay. And good morning. Thank you for saying good morning. Tips are $5 a day. I'm just going to get to the point. Tips are $5 a day. The IRS allows $5 a day you can write off in tips for all those people that you got to give the money to for helping you out. So that's tips. So we've kind of talked about travel. The other thing that kind of goes hand in hand with travel is meals. So it's generally the IRS allows 50% of your meals to be deductible, and they need to be within reason. If you normally go to Outback Steakhouse, that's pretty reasonable, right? That's kind of run of the mill, no problem. So, but then you decide that this is a business trip, I'm going to live it up, and I'm going to go to Ruth Chris. It's a little outside the normal. So you got to think of what's normal in the course of your business. So I work at Whatnot is my side gig or my part-time thing. I have a professional job, 9 to 5 every day, that I do travel for. It is more of a higher end. We're entertaining clients. We do go to a lot fancier places, and that is a normal expense for that. But if I were to try to do that for Whatnot, it wouldn't fit. It wouldn't fit what I'm doing on Whatnot. So again, it's gray area, but you just have to think about it logically and apply your common sense to the situation. So that is meals, 50%, and they need to be ordinary and necessary. On the other hand, if you're like, oh, that's a lot of rules, I don't want to deal with, is this allowed, is this not allowed for meals? The IRS offers a standard meal allowance every day. So there's a publication out there. When you get into it again, talk to your CPA or accountant. They can help you. There is a set dollar amount, and it varies. That's why I can't give you the number, because it varies by like the location of where you are in the United States. But there's a set dollar amount. You can take that instead. I think that's easier when you're traveling. All right, back to the form. Utilities. Let's see, line 25, we are on utilities now. Your cell phone, that's probably the biggest thing we see, is your cell phone. Do not include utilities here for your home office expense. That goes into your home office. We're going to come to that in a little bit. However, if you have a warehouse or you have another location that you pay for that you do business out of, and you've got to pay electric or water or gas, any of those utilities, internet, that would all go here. Again, along with your cell phone. Now, the IRS rules, they were so funny. I was looking at them this morning, and it says, for the first phone line going into your home, that is not deductible. Any secondary phone lines are. I paraphrased it, but that's basically what the IRS rules said. And I'm like, how outdated is that? Who even has landlines? But let's just think about that in more modern terms. If you have a cell phone, my phone, I use about 50% for whatnot, 50% for personal and other things. I wouldn't take the whole cost of it. I would take only about 50% of it. What the IRS is basically saying when it comes to phones is be reasonable. You know you're using it for personal. It's not just business, unless you have a secondary line that is 100% business, and that's 100% deductible. If you only have one cell phone, like most of us do, be reasonable in your allocation of what's business, what's personal. You don't have to keep a log. You just need to be reasonable, and then you don't need to worry about it. Okay, so we talked utilities, wages. Now, this is where you get a little bit of flexibility here. We are on line 26. This is if you pay employees. And a lot of you are going to say, oh, I don't have employees. Skip it. Don't have employees, skip it. I don't have employees. But you know what I do have? I have a kid. And she is my employee. What is the form number we are working on? We are on Schedule C. Let's see if I can show you real quick. We are on Schedule C, Profit and Loss, for Form 1040, and we are going over expenses. You are very welcome. We're going over expenses, and we are on wages. And I was just saying, most of us don't have employees, but some of us have kids, and my kid is my employee. Here's why. This is one of those ways where you can turn money that you would normally spend that is not deductible into a legitimate deductible business expense. So I have a 14-year-old. Does she work in my business? No, but she helps take boxes, carry boxes up. She may help with some of my packing. She helps when I'm cleaning up. She helps moving inventory around. When I'm putting up shelving, she's there helping. She helps cleaning up. So there's parts of the business she does help in. Is she on Whatnot Selling? No, but that doesn't mean she's not working for my business. When I have to go shopping and pick things up, she's there. She's, picking out things for me, helping me carry things to the car, putting it away, all of those things. She is my employee. I now can pay her up to $12,500, give or take a little bit there, in money, tax-free. She doesn't have to claim it because she would be under the standard deduction amount, so she doesn't have to file a tax return. And this is assuming that child has no other income. So that's on that assumption. So she doesn't have to file a tax return. She pays no taxes on it because she's my child working for my business, and she's making less than that $12,500. I don't have to file taxes. I pay no Social Security, no Medicare, no withholding for her. And I get to take money that I would pay her or spend on her as a business expense. So instead of giving her a check, instead of writing my daughter a check, guess what I do? I pay for her cheer. I pay for her tuition at cheer. I pay for her tumbling. Let's see. What if it's an adult child helping you and she has her own job? That would be a completely different story because her own job, do I have to do? So if you have an adult child, so when I talk about children, it has to be a dependent on your tax return. So if your adult child is a dependent on your tax return, this would apply to you. Keep in mind, though, if they have their own job and income from you, that gets added together. If they get over that threshold of having to file a tax return, $12,500, somewhere in that ballpark, then you can't use this technique. So once they hit that, this becomes useless to you. So this really works well when you have teenagers or younger children, or maybe just maybe college age children that you're still claiming on your tax returns. And you don't even have to actually write them the checks. Like I was saying, she works in my business. I write a check to the activities. It's no different than if I gave her the money than she paid for her cheer. So we're just bypassing that, making it simple. And now that takes an expense that's not deductible and legitimately makes it a business expense. But on the same note, legitimately, that child has to do something for the business. So They can't just be like existing. They do have to do something. So I give her regular jobs and duties to help me in my business. Let's see, we have a question. My mom is my dependent and retired. Would this count? Yes. So if your mother is listed on your tax return, there's some very specific rules about listing like elderly parents on your return. But if she is listed as your dependent, this would apply. Yes. What would you put in the tax form to show that? I'm sorry, I missed a bit earlier. Okay, so we are on Schedule C, line 26 of Schedule C, where it says wages. That's where you would put their wages. So you would put wages to employees, actual legit employees you have that you're paying their payroll taxes and all of that, or the wages you would pay to your child or your dependent that's on your tax return. You're very welcome. Thank you for being here. I appreciate it. All right, so let's move on to line 27A. This is other expenses from line 48. Don't worry that it says line 48. I'll show you what that is. What's important here is other expenses. Other expenses are anything we haven't talked about. If you can think of something that we have not discussed, a specific place on this form for, that's another expense. Let me see. I'm trying to think of an example of what would be an other expense. Oh, thank you for the tip. That is so sweet of you. I appreciate that. Just basically anything else that's not already on the form that you paid money for is an other expense. I'm sorry, I can't read it. P.O. Box, perfect. There you go. Yep, P.O. Box would be a great one. So you could put P.O. Box fees on there. I help a friend of mine with his taxes. He has a rental. He rents some properties, and we always put some of the cleaning fees on there for him, for his rental property, because there's no really place to put cleaning fees in the Schedule C. So anything that you're kind of looking through, you've organized all of your expenses, and you're like, I don't see a line for this, but it was a legit business expense. That's where it goes. You add all those together, and you put them in other expense. Now, if we go down to that line 48, we're going to skip over a little bit here, and we're going to go all the way down to that line 48 to show you what it looks like. You keep going. That's right here, Part 5, other expenses, and you just list them. So you have a blank, big old blank line. Space used in your home is home office, and we're about to get into that next. So that goes in a very specific spot. But all those other expenses, see, you total them up, it's line 48, and you just write them there. So you would write P.O. Box, and then you would come over here and you would put the total in, and then all of those other ones, you add them up. Okay? Let's see, is that where you put your purchases to use in the business? No, your purchases, that's actually part of the income. That is Part 3, right here, cost of goods sold. That's where you put your purchases. I would suggest on that, because we did talk about income. There's so much, I can talk for another 2 hours on just that section alone. Check out our YouTube. And last month's talk show I did, we went over each line of this in detail. So I would say go there, and if you still have questions, message me. Our YouTube handle is up there. If you still have questions, message me. I'm always happy to try to answer questions in the meantime. So we talked about other expenses. Okay, we're going to stay on this form. So we had line 27 was our other expenses. We are now going to add up all of those rows, all of those expenses. We're going to add them up. All right. So total expenses for line 28 before expenses for business use of your home. So we're going to add everything up. Okay. Then we're going to get to business expenses of our home. So line 30, expenses for business use of your home. Says do not report these expenses elsewhere. That means don't put them anywhere else on your form. And it says to attach a form 8829 unless you're using the simplified method. So let's talk about this. We have two ways to report our business use of our home. We can use this form 8829, and that's taking your actual expenses for the use of your home. When we talk about your home, maybe you have a whole bedroom. Maybe you're like me and I have an area of my basement sectioned off, and that's my whatnot area. Maybe you have a dining room. Maybe you have a corner of a living room. Whatever it may be, that's the section of your home. You need to get the square footage of that, because you can't take the whole house because you live in it. The whole house isn't business. You're only looking at the business portion. And that business portion, per the IRS regulations, needs to be used exclusively and primarily for the business. Doesn't mean that you can't make a sandwich and come down to your whatnot area and eat a sandwich. No, you can do that, of course, but exclusively and primarily. So let me kind of give you an example here. And I don't think we can show it on camera. I don't think we're set up today to show it. But I have a basement. I have in front of me, I'm staring at it right now. I've like hung a curtain up in my basement. My husband may be able to show it. He's going to turn this around. On this side of the curtain, right here, you can see this is my whatnot area. It's maybe a 10 by 10, 10 by 12 area. On the other side of my curtain is my home gym. That's my personal area. So we're going to see if we can kind of show you, give you an idea on what's what. So we are turning, here's my whatnot area. There's where I do shows. That's my backdrop. Yada, yada, yada. It's all my husband's equipment. And there's my curtain. On the other side of that curtain, if I were to open it up, which I don't know if he's going to do, you would see my treadmill and my Peloton. That's my personal area. You don't have to necessarily have walls up to make it a business area. I can measure from where my curtain is, and here he goes. All right. So if I turn it around, that's my messy boxes over there, and my personal area. All right. They've seen enough of my messy boxes, honey. Leave it to a man to show the messy boxes. All right, let's come back to me. We did have what if you use an outside shop in your yard? What's the square footage of your shop? That would be your home office. You figure out the square footage, 8 by 10, 12 by 12. It still applies. So you've established what your home office is. That's the first step. And if you're going to use Form 8829, it's just a form to help you figure out all your home office expenses. You can use the actual. So first off, I get my square footage. If I'm renting or if I'm paying a mortgage, I figure out how much does it cost per square foot, multiply that by my square footage, and that's my kind of use of that space. I get a percentage for that. Maybe it's 10% of my home I'm using or 3% of my home based on that square footage. I can then calculate electric, gas if it's used. If that part of your home includes water that you use in the business, you can include the water. Any expenses, internet, that would go into that home office. You just kind of figure it out on this form. You list all those expenses and you take that percentage of the square footage. Now there's a lot of calculations and a lot of numbers that go into that one. The other way to do it, the easy way to do it, is to use the simplified method. The simplified method basically says you figure out that square footage and the IRS is going to give you $5 per square foot. Super simple. That way you don't need to say, I don't need to calculate what the electric was or what the gas was or what this was or that was. I just know I need to know my square footage, multiply that by $5, and I pop it on this form. There's my home office expense. Nice and easy. Now, the beauty of this, which is very, very odd, and very, very odd for the IRS, it allows you to pick which one you want. What form? Schedule C. It is Schedule C of your 1040. And we are on line 30, expenses for the business use of your home. And it allows you to take either the simplified method or you have to go over to Form 8829 and calculate every little piece. The beauty of this is, normally, when the IRS gives you an option of something, once you pick an option, you're kind of locked in for the future without jumping through a bunch of hoops to change it. Here, the IRS is like, hey, I don't care. You can use Form 8829 one year, and the next year you can use the simplified method. So you can switch back and forth. Very rare for the IRS to do that. So pick which one works the best for you. This may be one of those things where you get with your accountant or your CPA and you look at both ways and take the one that's going to give you the biggest deduction. You're allowed to. So say if I calculate, I take into account all the things we talked about and I calculate it on the Form 8829 and I come up with a $2,000 deduction. But then I calculate it by multiplying my square footage by the $5 and I come up with a $2,500 deduction. I can just take the larger one. So this is a way to make it more beneficial to you. Let's see, there is a question. At what amount do you have to start claiming income from this? Good question. That is $1. The answer for IRS purposes is $1. So you are supposed to, per the IRS, report every dollar earned. So all your money you're supposed to report to the IRS. Now there are some certain thresholds that if you make less than $12,500 as a single individual, you don't have to file a return. That's basically then you get the first $12,000 tax free, right? So you look at the IRS rules, but as far as business money goes, you're supposed to start counting at that first dollar. I missed a question somewhere. Oh, does what not commission go in other fees? Sorry, I missed your question. My husband just brought it to my attention. You can put it in other fees. Yeah, so you can put it on line 10 for commissions and fees, or you can put it down on line 48 and just those other expenses. It's one of those kind of, you can put it either way. As long as you're putting it on there, you're fine. I would put it under line 10, commissions and fees. That's where I would put it. I think that's the most appropriate. Oh, don't be embarrassed. So Purple Pixie fines, absolutely not. I'm a CPA, and this is our job. And I don't say this to be like, I don't know, sound like snooty or something, but generally, like, financial stuff and accounting isn't most people's cup of tea. Like, why do people do whatnot? Because you like whatever it is you sell, whether it's clothing, antiques, vintage decor. You get into what you love. So as a CPA, like most of the people when I'm in practice, they don't like this stuff. They don't do this stuff. And we recognize that. That's why we're here, because we do love it. So don't be embarrassed at all. Let's see. As a sole proprietorship, do I put this on my normal household 1040 as income? If no, where do I put my cost of goods minus sales if I took a loss? So this is I can't read the name, the accessory, I can't see it from here, I'm sorry, Alchemist. My print is so tiny up there on my screen. So that as a sole proprietor, you will file Schedule C. That's what we've been kind of going over here. So Schedule C, it's part of your Form 1040. So you put all of your income, all of your expenses on that Schedule C. I went over income on my last show, and I probably spent over an hour on that, but it is on YouTube if you want to see it. We go line by line to talk about income. It all goes on your Schedule C. That's part of income, right? Yes. So your cost of goods is actually part of your income. So it deducts from your income, your cost of goods. So you put everything, all that money that came in, so all of your sales, you add it all together, you put it there in income, you figure out your cost of goods sold, and that reduces the income. That's like the first deduction you get. Do you have a checklist on what should bring to the CPA? I don't have a checklist, but if you Google Schedule C, so if you just type into Google form Schedule C 1040, it'll bring you up the form that we're looking at. And I would use that as a checklist. I would start walking through it and okay, I would say, hold on, I'm trying to read the comments. I would start walking through it and looking at all of those expenses we're talking about and just gathering that information. So basically what you need to bring to your CPA is all of your income, your 1099s that you received, plus your record of income. Because the CPA is going to want to match up what you say you got versus what other people say you got. The 1099 is what the other people, PayPal, whatnot, eBay, whatever, what they say you got. They're going to want to match that up to see if there's discrepancies and how close those are. So all of your accounting records and all of your expenses. And honestly, maybe your guys' CPA may be different, but if you just bring a box of receipts and dump it, you're going to get charged a lot of money, because for us to spend our time to sit there and add receipts, you're getting charged by the hour. So as a CPA, I would recommend that you calculate all your receipts and categorize them. Hey, this is advertising, this is this is this. If you don't know, create a list of what you don't know how to categorize. It's like, hey, I spent money here, I'm not sure where it goes, here's how much I spent. Then at least you have a nice organized list that the CPA can kind of go through. And this is just going to save you guys money. The more organized you are going to your CPA, the less money you're going to spend. Let's see, confused, does electric, internet go under utilities or home expense? So under utilities would only be if you have like a separate facility. We're not talking home office whatsoever. If you have a warehouse that you use, if you actually rent an office space somewhere that you pay utilities for, that's where those utilities go. For your home office, for that, the bedroom you use in your home, the dining room, the portioned off basement, that's home office. That goes down there on line 30 using one of the two methods. How do you account for goods without receipts? Purchase at garage sales. Great question. So if you've purchased something at a garage sale, obviously they're not going to give you a receipt. Keep a little log. Write it down. You have to know for your own purposes, right? Like you want to know how much money you spent. So you're writing it somewhere. I hope you're keeping some type of accounting record. So you can put, if you're using QuickBooks, type it in, no receipt given when garage sale purchase. And I purchased antique decor. Like put a little memo of what you got, just so you can recall what it is. If you're doing your bookkeeping by paper and you're just using a notebook, just write it down. That's all you need to do. Sure, I ask as many questions as you want. One more question. So I can't read that print. It is too small. Can you read the question to me?
So I sell honey on here.
Okay.
And legally I don't have to claim honey sales up to 50,000. Would this still apply to sales on one up?
So that's really interesting. So I don't know anything about like the honey sales, if you have to claim that money or not. I know from an IRS perspective that you're supposed to claim all income. However, the IRS does have certain exceptions for various things. I have never come across the honey thing, but do you have a pen? Let me find, I'm gonna write this down and I will look into it and see if I can find any information on it, because that interests me. I always love to learn new things. So my initial answer is, from my knowledge of the IRS, you're supposed to be claiming all income. However, if there are exemptions and honey is one of them, wonderful. I am going to look that up and I will get back to you. Let me just write down your name so I can make sure. All right. So I will let you know what I find out about that. All right. Home office. So we've talked about just using the simplified method or really kind of counting all of your expenses, one or the other. Oh, well, thank you so much. You know what? I am a geek. I'm a CPA, been a CPA for a little over 20 years now, with a background in both working on taxes and auditing. And I started reselling quite a while ago, started Whatnot for a little over a year, and I'm just geeky. I love this stuff. I think exempt from sales tax, not income tax. That very could be, yes. And that you bring up a great point. When we say taxes, there's a ton of different taxes in this world, as we know. We get hit every which way. Sales tax is all handled at the state and county levels, whereas income tax is federal level. So they're two very completely different things. And when I'm talking tax, I'm talking federal tax. All right, so let's keep moving on. We're going to go back to this form. We've done our home office. Let's see. Thank you so much. Oh, I'm catching the show late, but thank you. Well, I appreciate you jumping in. If you guys are missing any part of this, we are on YouTube. We do put all of our shows up there, even our past ones, and we do this once a month. So check that out. All right, let's go back to this form. So we just did line 30, which is expenses for business use of your home. We talked about you can do one method or the other. Thank you for sharing this live stream. I really appreciate that. So then we get to line 31. This is the bottom number. This is your net profit or loss. All right, here's the big reveal. It's under Zoe's Treasures. My husband's putting it on the screen right now. So Zoe T actually stands for Zoe's Treasures, but I was a buyer on Whatnot before I was a seller. And so I started with Zoe T. Then I started being a seller, and I was like, I was going to change it to Zoe's Treasures, but I'd already felt like I was building up some recognition as Zoe T, so I just left it. But that's what it stands for. All right, line 31, net profit or loss. This is where we find out, am I going to owe money? Do I get to take a loss? What's happening here? So it says subtract line 30 from line 29. So like any other tax form, as you're going through here, you're filling in the boxes. They're going to tell you when to add stuff, when to subtract stuff. You just follow that instructions. So we get to line 30 is going to give you your bottom line. That's your taxable income from the business. Okay. Now, that taxable number is not going to be the same as your cash flow. That's a completely different number than the cash you may have made in the business. Because let's think about this. Let's just like purely high level. In some of the expenses we've talked about, we've talked about paying your kids, wages. We've talked about depreciation. Some of these expenses aren't actual cash flows that you're seeing going out. So if you've done your accounting and you've added all your revenue and then you've taken out all of your expenses and you come up with a net number, that bottom line number may very well be different than your bottom line number on your tax, because there's things we could deduct for taxes that aren't really a cash outlay, or they appear differently on your tax return. And honestly, the goal, this isn't your big business goal, but when we're talking solely of doing your taxes, the goal is to hopefully have that line 30 be as low as possible. Because here's the thinking of this. Line 30 that's going to tell you how much self-employment tax that you need to pay and how much withholding tax you need to pay on that federal tax. I want that to be as low as possible because I want to pay the least amount of taxes, right? So that's kind of the goal. I want to make sure I'm getting all my expenses in there. I want to put everything I can legally into that form. However, if line 30 is a big number and you got to pay taxes, it sucks. Trust me, I know. I've been there. I've written a check to the IRS too many times. But the only reason you pay taxes is because you made money. It's like, I always relate it to this. You have a banger show, the best whatnot show you've ever had, but then you spend 6 hours packing and shipping, and then by about hour 4, you're like, oh, if I see another box. And I get there, but you know what? You're only packing and shipping because you made so many sales, because you did so great. So I always kind of like to throw that in there, because I have years and years of working with people and they're like, oh, I got to pay taxes. No, you didn't do your job. You didn't get me down to zero. I'm like, no, you're paying taxes because you had a great year. You made some money. Be thankful. So that's just kind of my 2 cents. That's just my little soapbox I always get on. Let's see. Best way to set up a whatnot business. S Corp. Oh, you just asked my favorite question. All right. LLC. This is my other soapbox. LLC, S Corp. You know what the best way to set up a whatnot business is? What works for you. However, an S Corp and an LLC, just legal standings. They're business structures. I could be just me. My name is Tracy. I'm Zoe's Treasures. I'm a sole proprietor. And I'm a business. I am just as much of a business as somebody who's incorporated as an LLC. So why would you incorporate as an LLC or an S Corp? What is your business goals? How is that business structured? If it's just you, let's just say it's just you. Let's make it you and your spouse. There's the two of you. And you want to do an LLC. All that gives you is legal protection. Do you need legal protection? Let's first talk about it from a tax perspective. As a sole proprietor, I file Schedule C on my 1040. As a single member, or me and my spouse, LLC, guess where I file my taxes? Schedule C on 1040, the exact same way. So why would I want to go through the trouble of being an LLC for tax purposes if I'm going to be taxed the exact same way and it doesn't make a difference? That's where we get into the legal aspect of it. An LLC provides an umbrella over your business for legal protection if you need to separate your business assets from your personal assets. There are times where there's very legitimate reasons why you would want to do that. Maybe you're working in a warehouse. Maybe I see some big sellers on here who have a warehouse. They have employees. They have a lot more liability. They have people coming and going. People can sue them. Their employees can sue them. They want to protect their personal assets from their business assets. That may be a legit reason to do an LLC. That's something you really need to look at your big picture and decide with an attorney or a CPA if filing an LLC is really worth it. Because once you file that LLC, most states, thank you so much, I appreciate you. Some states I'd say most states, not some, most states, for that LLC, you have to pay an annual fee for that every single month. You are not month, sorry, every year. You reinstate that like every year. It's like a license. We talked about that. That's on one of the lines that you can fill out on your Schedule C, one of the expenses you can take. So why would you, if you don't need it for that legal protection, it really doesn't make a lot of sense. But again, I can't speak for you. Like, you need to look at your whole picture, and everybody's picture is unique. But if you're just a sole proprietor doing whatnot from your home somewhere, you're just selling stuff, do you really need to from a tax perspective? Probably not. So, because you're going to end up filing it in the same place. Now, if you have business partners, completely different story. If you and your best friend are doing this, now you have two people. You can still do it as a sole proprietor, but you got to split everything in half. The accounting becomes a little bit more messy. You know, it's not as clean and neat. They're only going to issue you, like Whatnot's going to issue a 1099 to one of you. So now one of you needs to explain how to get income to the other. It's getting more messy because it's not within your little family unit. It's not you and your spouse, or it's not you. It's you and somebody else who files their own tax return. Now maybe an LLC makes sense because now it's not a single member. You're an LLC. Now you file a completely separate tax form and you issue what's called K-1s, one to your partner, one to you. That tells the IRS how much income you should have, how much income they should have. So it really depends on that situation. An S-Corp is just a designation, and it's a different tax form, a few different rules apply, how many investors you can have, how that income flows through. So it's just legally a different structure. But again, not needed as a single person unless maybe there's some assets or something you're trying to protect. So it's really, take a look at your big picture, everything that's going on, talk to your CPA about that. But I hear that a lot. I hear so many people saying, oh, I need to do an LLC, and you'll even see it being pushed. Like if you try to join QuickBooks or something, are you ready to start your LLC? Or if you scroll Facebook a lot, and it's like, at least make sure you're knowledgeable before you take that leap, because once you do it, it's hard to get out of it. Did you cover inventory? Yep, just joining. Hi, Vintage Venture. And did you cover inventory management, cash versus accrual accounting? Okay, I have not. I'll touch on it a little bit. But let me just finish up on the LLC. If you form an LLC, like you fell into this hype and you're like, oh, I need to do this, and you didn't really maybe have all the knowledge about it, you can dissolve it. It takes a little bit more. It's harder to dissolve it. You actually have to file paperwork to dissolve it with your state. If you're a sole proprietor, I'm just me, and I decide tomorrow I'm sick of this, I don't want to do Whatnot anymore, guess what I have to do? Turn my phone off, stop my Whatnot account, that's it. I'm done. I don't have to do anything as a sole proprietor, so it's so much easier that way. All right, let's see. I'm going to get to the inventory accrual accounting. I was advised at tuition to do an S Corp, but my business is a C Corp. Okay, so if your business is a C Corp, maybe there was a specific reason why your CPA financial advisor told you to do a C Corp, because there's a lot of, like I said, a lot of little details that go into that. You can always elect to be an S Corp after the fact. So I would talk to them. If you want to be an S Corp, you can always allow. And S Corp does allow a few caveats that a C Corp doesn't. Makes it a little bit easier in some senses. So I would definitely talk to your advisor. Just because you're a C Corp now doesn't mean that you can't change to an S Corp. S Corp is an election that you make with the IRS. What is the depreciation on the vehicle? Do we use this? So you only use depreciation on a vehicle if you are taking your actual expenses for a vehicle. Hold on, I just want to jot down, I don't want to forget Vintage Veterans, cash versus accrual, because we are going to get to that. It's just a big topic. I'm going to come back to that. Okay. So if you are taking actual expenses on your vehicle, and I go and buy a truck to use in my business, in that case, it is a fixed asset. It's an asset that has a useful life of longer than a year, and it's usually more expensive than whatever my threshold is, a $500,000 threshold. I can't say I bought a $50,000 truck and expense that all at once. I have to take it over the useful life of that truck. So if a vehicle lasts, I think the IRS recommends around 7 years, I can only take 1/7 of that expense every single year. And that is only if you are doing actual expenses on a vehicle that sole purpose is for business. I personally choose to take the mileage method, which is just so much easier. The actual, you're required to use actual if you have a fleet of vehicles, if you have more than 5 vehicles. For whatnot, most of that doesn't apply usually. So it's a little bit less record keeping, easier to do to take the standard mileage rate. When you purchase merchandise from a friend to resell on here, could you just write her a receipt for the amount that you purchased it for? You could. They could just write you a receipt, or you just put a note in your accounting records. Yeah, absolutely. Great. I had an LLC once, never again for very small business. Absolutely. I agree with you. If you're a sole proprietor, sometimes they're more a pain than they are a blessing. So you absolutely have to file something different. It's a whole other tax return that you file. And then what happens, you file, it's a business return. I'm trying to think the name of the C Corp form. It's been so long since I've done it. Might be 1120 is S Corp, 1065 is LLC. I cannot think of the form for the C Corp off the top of my head. It is a whole nother tax form. And then that tax form with the C Corp would give you a dividend statement. 1065 is an LLC. That's if you own an LLC that is more than a single member. Only for a multi-member LLC, you file a 1065. Single member LLC, it goes on your 1040. It goes right on your personal tax return. But for a C Corp, yes, it's a lot more to do with it. I normally don't talk a lot of C Corp, S Corp tax here, just because the majority of the audience is sole proprietors.
So if you're
Merchandise to resell, you can count your mile. Yes, yep, absolutely. So if you're going to thrift stores, you're going to the post office, doing all that, that's all mileage. Just keep a log. Electronic log is fine, doesn't have to be written down. Corporate taxes and LLCs are due March 15th. Yes, they are. So March 15th, you better have either filed your taxes or an extension if you are a corp, C Corp or an S Corp, LLC. They're all due March 15th. Ours, 1040s, are due April 15th. You can file an extension. However, if you owe taxes, you must pay the tax on April 15th, but you can do an extension to actually turn in the paperwork. So just keep that in mind. So if you're doing this on your own, if you're doing your taxes on your own, especially for the first time, and you think there's a possibility that you may owe money, make sure you're getting that done before April 15th, even if you don't mail it in, because with your extension, you need to write that check if you're going to owe. But let's get back to this form real quick. Oh, wait, no, before we get back to the form, let's talk cash versus accrual accounting. I said I was going to come back to that question because that's a big one. All right, so when we're looking at our Schedule C, and let's go back to our form here so I can show you exactly where you're going to see this. So we are at the very top of this form, Schedule C. I can't pull it down anymore. Schedule C right there. You put in the very top, business name, address, all your basic information. That doesn't need any explanation. You know what that is. Then you get to line F, and it says accounting method. Cash, accrual, or other. We're going to skip other. 99.9% of the time it's not going to apply. So we're going to speak to the masses. Cash or accrual. Cash is straight up cash. That is what comes in, what goes out, dollar for dollar. No other adjustments being made. It's exactly what I have coming in and exactly what I spend. While that may seem easier, you can pick that for business purpose, for tax purposes. It may be easier for tax purposes. It gives you almost zero benefit for business purposes. It doesn't give you the information you need to make educated business decisions. It just makes it easier for tax. As a CPA, I've never used cash. I shy away from cash. I don't. In the past, when I've had clients that I did tax work for, we've never done cash. However, if you're kind of doing this on the side, it's a hobby. You're not really looking at it like trying to make business decisions, trying to grow, trying to use your information in an analytical format to make those decisions. Cash may work for you. I'm not saying that you shouldn't do it. It depends what your needs are. Accrual accounting is when you account for those things that are about to occur or have yet to occur. So you're getting expenses put on your books, even if you haven't paid for it. Even if it wasn't an expense, you can claim that expense, or you're spreading out the expense. You're matching, accrual accounting is matching the income to the expense in the period that it happened. High level example, because this is going deep into accounting, so I'm going to give a very high level example just to kind of keep this as light as possible. I come to December 31st, it's the end of my year. I'm doing my books. And I went ahead on December 30th. I am assuming, let's just get some assumptions. I'm assuming that I own a warehouse and I'm paying some rent for this warehouse. On December 30th, I write a check for rent for January 1st because you know what's going to take a couple days for it to get to my landlord. So I write for my warehouse that I do my business out of my rent check on December 30th for my January rent. That is a prepaid expense. That's not an expense for my taxes for December. That's next year's expense. I just paid it early. Did the money come out of my bank? Probably. I don't get to claim that on my taxes this year because I paid it early. It's an expense for next year. That's prepaid. It also works backwards. It works the opposite. I come December 31st, we're talking I have my same warehouse. I know the middle of January, I'm going to have to pay the electric bill, and that electric bill covers my use in December. So I use the electric all month in my warehouse. They send me a bill, I pay the bill in January. I would accrue that expense as of December 31st. I may not know what my bill is going to be, what the electric company is going to send the bill for, but I could estimate what it's going to be, and I accrue that expense and put it into December because I used electric in December. I'm going to expense it in December. That's matching up my expense with the time period. That's accrual. It's a lot higher level accounting. Usually your accountant, your bookkeepers, your CPAs are taking care of that for you. I wouldn't worry about it. If they need something from you, they're going to say, hey, give me this so I can make sure I'm putting the right entries into your books. But on your tax return, you're going to pick cash or accrual. What is your basis of accounting? I would always do accrual. That's my perspective. You do what works for you because accrual gives you true information on what happened in the time period. It gives you information that you can analyze and use for future business decisions better than cash can. The next big example is I talk a lot about inventory management, and that was one of the other points in the question there was to talk about inventory management. I'm huge on accounting for your inventory and cost of goods sold the proper way. That means when I buy my inventory, so let's just take my coffee cup here. Let's say I'm going to sell this. This becomes inventory. I bought it. I went to the thrift store. I bought this beautiful mug here. I put money out. That's not an expense to my business. You're probably sitting there saying, yeah, but you spent money. Yes, I spent money. It's not an expense yet. It's cost of goods sold. This is an asset. This is an asset to my business because I took dollar bills, which is an asset, and I just traded it for a coffee cup, which is another asset. It's not an expense. Now, I go on Whatnot and I say, hey, everybody, I'm going to sell this coffee cup. We're going to start bidding at $1. Thank you for your bids. Thank you, thank you. It just sold for $10. Now it's an expense. Now I have $10 of revenue, and whatever I paid for it moves from my asset down to my expense. Now this cup, because I sold it, became an expense. That's accrual accounting for inventory. Zoe T, is the YouTube name the same as your Whatnot handle? It is Zoe's Treasures. My husband's putting it up on the screen right now. So that is proper inventory management. Now, cash inventory management, you are allowed to do that for tax purposes. But here's what's going to happen. I'm going to trade my dollars for this cup, and right then and there, this becomes an expense. Whatever I paid for it, this is automatically an expense. It never goes into that asset. What if I don't sell it right away? What if it takes me a year because this is such a special cup, it needs just the right buyer? What if it sits in my inventory for a year? I'm going to have this big cash outflow one year, but not the next, and then I get the big revenue inflow, but no outflow. It doesn't match. When I sold this doesn't match for when that revenue came in. So how can I make good decisions about my cost of revenue or my cost of goods? Am I really profiting? I don't have that revenue and expense to match together. So that's why I choose to stay away from the cash, always go for accrual. Again, talk to your CPA, figure out what works for you and what's best for you and what's best for your future business. Because you know what? You know the only reason why we do accounting? There's only two real reasons to do accounting. All this trouble that we go through to keep records, collect receipts, all that, two reasons. One, I got to file a tax return because the government tells me I have to. We're not getting into that discussion, but hey, it's the law. I've got to file this tax return. Two, the other reason, to make business decisions, to know what I did in the past, to either one, repeat it if it's great, or two, don't repeat it if it wasn't great. It's the only, he'll put it up there. Can you put the YouTube up? Thanks. And that's the only reason we do all this accounting, is so we know what we did to make decisions moving forward and to file tax returns. So that's it. That's the only reason. So let's see. All right, we're going to go back. We talked about Schedule C here. Let's just kind of head back and let's wrap this all up for our Schedule C. So we're going to kind of recap from the last two shows we did here. Can you switch over to the form for me, honey? All right. So Schedule C, the top of it, we said, is just your personal information. You know all that. We talked about if it's cash or accrual. Did you materially participate? Did you do this business? Or were you just an investor? That's what it's asking. Did you just, like, you and your best friend are going into whatnot, and you gave them a couple $1,000s and you said, here you go take care of that business. They materially participated, you didn't. Are you working your business is basically what it's asking in common language. Oh, thank you, Vintage Veteran. I appreciate that. If you started or acquired this business, nice, easy question. Did you make any payments that require you to file Forms 1099? Remember, we said if you have to file that 1099, you're gonna see that down there on line 11, contract labor. So if you answer yes to did you make any payments that require 1099, you probably need to have something on line 11 too. All right. So we kind of go through, then we talk about our income. So it goes through, you do your income, your cost of goods sold, you figure out what your total income is, and then you go through all these expense lines and you're gathering everything you can think of. And don't forget, and I do this every year because you know what, even though I feel I keep pretty good records, I mean, I'm a CPA, I know how to keep records, right? At the end of the year, there's still stuff that I forget about and still stuff that I miss. So I have like a practice of, I sit down with my husband and I say, pull up your eBay. Let's look through your eBay purchases. Is there anything that I forgot to record that you bought for the business? I pull up my eBay purchases. We go to Amazon. We do the same thing. Is there anything we forgot to put in here? Let's look at the credit cards we use. Hopefully you don't use too many to make it easy. Let's look through our credit card statements. Is there anything we forgot? Let's go through the bank because sometimes there's some odd subscription that you forget about that oh, wow, I paid for that. I forgot I paid. Perfect example. Maybe you use Canva to create your thumbnails. That's an easy one to like, oh, it's hooked up to my Apple Pay. I never think about it. It comes right out of the bank. And I forgot to record it. That can add up. Another good one that I forget about a lot, this is my own personal thing. And I will answer your question in 1 second. Thank you for asking it. And if you could help me put a question mark afterwards, it makes it yellow, just makes it pop to me more so I know you have a question. But I'll answer it in just 1 second. One of the expenses I forget about a lot is Vendoo. I don't know if any of you use them. I'm not promoting them. I use them just because I like them. But sometimes I run out of like my little subscription. I run out of my listings and then I have to buy more on the fly. And that just hits my account. Sometimes I forget to write that down. So make sure you're gathering all that information. Let me check out these questions real quick. Do you have to have your employee on paperwork to add them in wages? Well, yes and no. It depends who the employee is. So if you have a legit employee, hopefully you have the paperwork and you're filing payroll taxes. So everything is already on paperwork. So if you have a real employee that you're paying wages, you should be withholding their withholding tax, Social Security, Medicare, and then you're filing quarterly payroll tax returns. So they are on paper, so you can put them in there. If it's your child, your dependent that works for your business, you're not withholding any taxes. You can still use wages for your child that's your dependent that you're paying, and you can put it on there. So it kind of depends who your employee is. For a seller of collectible items, what is best practice for establishing base cost when selling items from your personal collection? So this is such a tricky thing. It depends on the personal collection. So kind of two ways to do this. If it falls into one of the IRS's collectible categories, and they kind of make it really broad, so sometimes it's that gray area. If it falls into one of the IRS collectible categories, it doesn't go on your business return. It's like a capital gain to you. It goes on form 8847, I want to say. Hold on, I can tell you. I wrote this down. This was I I talked about this on one of the shows, and I had some notes. Let me tell you what it is. So say this was, 8949, that's the form it would go on. If it's grandma's, no, let's just make it easy. You've collected baseball cards since you were a kid. You have this huge collection of baseball cards, and now you're going to sell them. That is considered one of IRS's collectibles. That's not a business expense. It doesn't go on your Schedule C at all. It goes on Form 8949, which flows to a Schedule D that flows into your personal tax return. So that's not business. If, since I've been an adult, I've had my own home, I've, bought stuff at different antique stores or whatever to decorate my house, and then I do whatnot, and I decide, you know what, I'm going to redecorate. I'm going to take a lot of this stuff and I'm going to sell it on whatnot because I want to redecorate this room. That's not so much a collectible. That's more of a personal. What I would do at the date you decided to bring them into your business, create the value for them. What's the thrift store value at that date? If you were to go and buy that vase or whatever it is at a store on that date, instead of pulling it off the shelf in your living room, how much would you have paid for it? Write that down as the basis for your business. Create some type of record system for that. It could be as easy as a piece of paper that you stick into a filing cabinet. That's your basis. If the employee, can I elaborate on same as partner? Or is the employee your spouse? Oh, this is a fun one. So this is part of my tips and tricks. If the employee is your spouse. So I said that I had wrote down a few tips and tricks on how to make the most of your tax situation. And you just hit the nail on the head as one of your tricks. So if I hire my husband, so my husband's sitting right over here across from me running the cameras. We don't really take paychecks from our business. We're a sole proprietor. But if I want to hire him, I would have to hire him as an employee. I would have to do payroll taxes. It becomes a pain in my butt. I don't want to do that, right? How to get around that. How to not pay payroll taxes for your spouse that you're filing a joint return for. You don't actually pay them, but you are allowed to pay for any medical expenses that the family has incurred as payment to your spouse. So I'm never writing him a check, but I'm buying his prescriptions, I'm paying his copays, whatever it may be, and that's his wages. That way you can take medical expenses and make them 100% deductible on your Schedule C. That's one of the little, I hate to say loopholes because it's not really a loophole, but it is a legitimate legal way to make a non-deductible expense a deductible expense. So there's two ways to pay your spouse. Put them on payroll, treat them like everybody else. Or you hire your spouse, and instead of paying them, you pay any of their medical. This is a really good way if you have a spouse who's at home that maybe is not working for some disability purposes and they have high medical expenses. It's a great way to take some of those expenses and put them on as 100% deductible. Because if it's not 100% on your Schedule C, where does it go? It goes on your Schedule A, and you're limited. First of all, you have to pay, I think it's up to 10%, and maybe 7, somewhere between 7 and 10% of your adjusted gross income. So say if you make $100,000 a year, first of all, your medical expenses have to exceed $7,000 to $10,000. Then you can start to deduct them. Well, all that goes away if your spouse is working in your business and you're paying their medical. It starts at 0, becoming deductible. You have to be doing a joint return. Absolutely. I would question, there are legitimate reasons why you wouldn't do a joint return for your spouse, but very few and far that are going to be beneficial in any way, shape, or form. So most times you're going to be doing a joint return with your spouse. Even if you are in some type of separation type position, you still should be filing a joint return until you are officially divorced. Again, there are certain circumstances and special things happening where that doesn't apply. So we've talked about tips and tricks. Hire your spouse. And if I missed any question, please feel free to throw it back in the chat if I missed any of the questions. I'm sorry. Tips and tricks. Hire your kids. Hire your spouse. Pay their medical expenses. Oh, thank you so much for coming in the show. I appreciate that. Rent from your spouse. So here you go. This is a way where you can also make some, let's see, before I go to that, I'm going to answer, does supplements or premium count for that? Only if the supplements or premiums are deductible on a Schedule A. So most of the times, yes. Most of the times, yes, that does count. So if you can deduct it normally for the IRS, it counts in this situation. So let's give an example of something not deductible medical. Cosmetic surgery. If it's not because you're disfigured and you need the cosmetic surgery to bring you back to a better state, if it's cosmetic surgery because, I need to look better in this bathing suit cosmetic surgery, that's not deductible. If it's, I've had some type of cancer and I'm having a reconstructive surgery, that's deductible. So you just got to look at the normal IRS rules. So as long as it falls into what the normal IRS says as medical expenses is deductible, then it works in this situation also. Renting from your spouse. This is another way to make an expense, make money that you would spend deductible that normally isn't deductible. So, and this only works if you have like another type of a building or something. So that person, I forget who it was, somebody in the chat earlier said, what if I have a shed in the back of my property, a completely separate building? Maybe it's not big, maybe it's just like a 12 by 12 shed or something, but it's in my backyard. That's where I do my whole business out of. If you create a contract, it has to be a written contract with your spouse. So say my husband will rent that shed to me. It's my business. My husband's renting that shed to me. We have a written contract. I pay him a certain dollar amount every month. We're the same family, so technically, it's our money anyways. I'm not really paying him. It's on paper that I'm paying him. My rent becomes deductible on my Schedule C. So it's a way to kind of reduce your taxable income. This is where I say what your bottom line on your Schedule C may not match your accounting records, because you may have stuff like that where I'm paying my husband or I'm paying my child, but it's not really, no money's really exchanging hands. So that's a way to reduce some of your taxable income. And then the final one is legit travel within the U.S. So we talked about travel, told you to be very careful, but if it is legit, you're taking a road trip to source primarily. That does not mean that if you're on a 4-day road trip to source and that's your primary business thing, that one night you can't go, to a dinner show or, it doesn't mean you can't have fun. That portion of the fun isn't deductible. Everything else could be deductible. All right. Real quick on vehicle, I do want to mention, because this is one of the things we talked a lot about, vehicle expenses. Normal commuting is not deductible. And this is a gray area that I see a lot of people have questions, but normal commuting. So you're an employee. Let's take whatnot out of this situation. Let's just say you have a 9-to-5 job. You drive to your job, 5 miles away every day. That's not deductible. That's you going to work. The same thing applies when you're a sole proprietor. Where it works to our benefit is most of us work at home. But if I have a warehouse that I drive to every single day to do my whatnot business, that's commuting. That's not deductible. I can't put that under my mileage. But if I leave that warehouse and I go to the post office or I go to source, that's deductible. Now, if you work at home, my commute is walking from my kitchen into my basement. No mileage there, right? So just about everything I do is deductible. Now you have to apply it with some common sense and just some honesty. A lot of times I will drive my daughter to drop her off at cheerleading practice, and then from there I will go to an antique store while she's spending 3 hours in cheerleading. My drive from my house to cheerleading, I can't deduct. That's not legitimate. I was going to drive there anyways. That's personal. But from cheerleading to the antique store and back to cheerleading, that's deductible. So just be reasonable. With that, if there's no other questions, we have been talking for a good hour and a half, and that's a lot of accounting and tax talk. I know it's a heavy subject. Can you put whatnot commissions and fees under other expenses, making sure? Yes, you can. You can put them under commissions and fees, or you can put them under office supply. I wouldn't do office supplies. Other expenses. Yep, absolutely. Some of these things, unless it's like wages, interest, unless it's like super specific, could fall into other expenses. As long as you're claiming it on there and you're writing that on the line, the IRS isn't really going to care. The worst the IRS can do in that case is come back and say, hey, I don't like where you wrote this. You need to write it on this line. And you're like, okay. You're not going to get fined or anything because it didn't change your taxable income. Like you didn't overpay or underpay. Everything was still there. So Do your best with it. Don't worry so much about like the nomenclature. Follow it as best you can. Oh, you're very welcome. How do you get a tax extension? There is just a simple form that you can go on to, just Google IRS tax extension, and it'll pull up the form. It should pop it up right for you. And you can fill it out and mail it in. It's super, super simple. I wish I don't know it right off the top of my head. I don't even have my computer. Oh, I've got my iPad, but to Google. And just make sure you file that before April 15th. So file your extension before April 15th. And if you owe money, if you think you're going to owe money, make sure you're paying it before April 15th so you don't get a big old fine. If you can't be done online, only by mail. I'm not sure if they've changed that, if it can be done online or not. It's been a while since I filed an extension, and I've always had to mail them. So if they've put it online in the last couple of years, like last year or two, that would be new to me. I have to go and look. It's just been so long I haven't filed an extension. I haven't even thought about it for the longest time. Thank you, 4868. Thank you. That is it. What am I saying? Oh, if you have to pay. My dad's for the, yes, it was March 15th. C Corps, S Corps, LLCs are all earlier. They're March. Personal is April. If you have to pay and you can't afford to pay it, like you got a big tax bill, still file. There's a form at the IRS. You can Google that too, but there's a form for the IRS where you can just say, hey, I can't afford to pay this. I need to set up installment payments. There's a little fee to set it up front, and of course you're going to be charged interest on it. But I don't want you to stress if you owe a tax bill and you don't have all the money right now, you can set up payments. It sucks. But again, the only reason you're paying taxes is because you made money. So remember that. As much as it sucks to write the check. So with that, I'm going to say thank you so much. We're going to be back next month. We'll still talk accounting and tax, but hopefully by next month, everybody would have filed their tax returns. If you have questions at all in the meantime, please feel free to message me. And thank you so much. I appreciate that, Vintage Veteran. Thank you for the coffee. If you have questions, again, please feel free to message me. I appreciate you guys. And if you've missed the prior shows, they're on YouTube. My husband's putting it up there. You can always watch those. And this one in its entirety will be on YouTube also. And hope to see you guys soon. We're going to go find somebody to raid. Hopefully my husband can do that. Last month I had to run over there and do it. But let's see if he can. No. All right. I'm going to go run around to the other side, and we're going to find somebody to raid. Thank you so much, guys.
Honey, what are you doing?
Nothing?